Welcome back to the Deep Dive. I'm your host, and today we are doing something a little different.
A little bit.
Usually we talk about the shiny stuff, the strategy, the big picture ideas, the how to get rich
Yeah.
stuff. But today we are popping the hood, grabbing a wrench, and taking a hard look at the engine itself.
And it is quite an engine. It's a machine built of, well, it's math, it's regulations, and a surprising amount of trust, actually.
It really is.
Hmm.
When I buy a stock, say I buy a share of Reliance or Tata Motors, I know what I'm buying.
Yeah.
I see a price ticking on a screen.
Yep.
It changes every second. It's visceral. It's supply and demand happening right there in real time. But when I hand over my money to a mutual fund, the whole process feels darker, more opaque.
It does. It feels like a black box, doesn't it? You put money in, you get a statement later saying, here's what it's worth.
Exactly.
Yeah.
And today we are asking, who decides that number? I mean, is it a guy in a back room with a calculator? Is it some complex algorithm? And most importantly, how do we know they aren't just, making it up?
That is the central question. When you buy a mutual fund, you aren't buying a distinct asset like a gold bar or a single share. You're buying a proportionate share of a massive, living, breathing portfolio.
A slice of the pie.
A tiny slice of a very big pie. So figuring out the price tag of that slice, what we call the net asset value, or NAV, is actually a massive logistical and ethical undertaking.
Ethical. See, that's the word that caught me off guard in the reading. I expected a finance lesson. I did not expect a lesson on ethics.
Oh, valuation is entirely about ethics. Think about it. If the price isn't right, if it's off by even a single pays, then every single time someone buys into the fund or sells out of the fund, a theft is occurring.
A theft. That's a strong word.
It is a theft. Either a person leaving is taking too much money, essentially robbing the people who stay, or the person who's just entering is paying too little and they're diluting the value for everyone who's already there.
Okay, wow. That raises the stakes quite a bit. So to guide us through this minefield, we are diving deep into the NISM series VA Mutual Fund Distributors Certification Examination Workbook. And specifically, we are laser-focused on Chapter 7.
Net asset value, total expense ratio, and pricing of units. It sounds dry, I know, it really does. But this chapter is basically the constitution of the mutual fund world. It sets all the rules of engagement.
So our mission today is to decode the mechanics of the NAV. We are going to find out where our money actually goes when we pay that mysterious expense ratio. And we're going to learn how you can spot a raw deal versus a fair price.
We're going to look at the mark-to-market mechanism, which is really the heartbeat of the whole system, and we'll explore some of the dark corners of fair valuation, which is where the math gets a little fuzzy and judgment calls have to be made.
And we'll talk about what happens when the engine breaks, when assets just stop trading, when panic sets in. So buckle up. Let's start with the absolute basics, but I want to push past the dictionary definition pretty quickly. The NAV, why don't they just call it the price?
That's a great question, because price implies a negotiation, right? It's between a buyer and a seller. If you sell your house, the price is whatever you and the buyer agree on.
Right. NAV is different. NAV is what we'd call a breakup value.
A breakup value. Okay, explain that.
Imagine the mutual fund is a giant warehouse full of stuff. Stocks, bonds, some cash, maybe some gold bars in the corner. Every day at 3:30 p.m. when the markets close, we lock the warehouse doors. The NAV calculation is essentially asking, if we sold absolutely everything in this warehouse right now, paid off the electricity bill and the security guard, how much cash would be left on the floor?
And then you divide that big pile of cash by the number of people standing outside who are holding a ticket to get in.
Exactly. That is the net asset value per unit.
Yeah.
It's not forward-looking. It doesn't care about what the market might do tomorrow. It is a scorecard of what is physically owned right this second.
This explains why you can't time a mutual fund intraday, right? I can't look at the market at 11 a.m., see it's up, and then decide to buy a mutual fund at the 11:00 a.m. price.
Correct. And that's a crucial concept called forward pricing. When you put in an order to buy a mutual fund, you are essentially buying a blind box.
You don't know the price. You don't know the price yet. You get the price that is calculated after the market closes that day. This prevents you or anyone from gaming the system based on intraday movements.
Okay, so let's look at the formula in section 7.2. It looks pretty simple on the surface. Total assets, liabilities, number of outstanding units. But let's unpack the assets part. It's not just the market value of the stocks, is it?
No, and this is where the accountants really earn their keep. Obviously, the biggest chunk is the investments. If the fund owns Infosys and HDFC Bank, we take the closing price of those stocks from the National Stock Exchange. That part's easy.
Okay.
But there's also something called accrued income.
Accrued income. This is a term that just glazes people's eyes over. Make it real for me.
Okay, let's imagine the fund holds a government bond. This bond pays interest to coupon twice a year, let's say on January 1st and July 1st. Now, let's say today is April 1st. The fund hasn't received a check since January and won't get another check until July. But for the last 3 months, January, February, March, that bond has been earning a little bit of interest every single day. It's just sitting there accumulating.
So even though the cash isn't physically in the bank account, the money has been earned. It's owed to the fund.
Exactly. Now, if you decide to sell your mutual fund units on April 1st, shouldn't you get paid for that interest the fund earned during the time you held it?
Ideally, yes. I should get my share of it.
That's accrued income. The accountant calculates the interest earned right up to this exact day and adds it to the assets pile. If they didn't do that and you sold today, you'd be walking away from 3 months of profit that was rightfully yours.
That makes perfect sense. It ensures that the value is recognized the moment it's earned, not just when the check finally clears.
Precisely. And the same thing goes for dividends. If a company declares a dividend but hasn't actually paid it yet, it's still an asset. And don't forget receivables. If the fund sold some shares yesterday, the cash hasn't arrived yet. Settlement takes a day or two, but that money is owed to the fund. It counts as an asset.
Okay, so we have this massive pile of assets. We've got the investments, the accrued income, the receivables. Now we have to subtract the liabilities, the bills.
Right. And just like we accrue income, we have to accrue expenses. The fund manager wants to get paid. The custodian who holds the securities, they want to get paid. The auditors need to be paid.
But they don't send a bill every single day.
No, but we have to account for it every day. The total expense ratio is an annual fee. Let's say it's 2%. But we don't just chop 2% off at the end of the year. We chop off 13/95 of that 2% every single day from the NAV.
So every day, the NAV is ticking down just a tiny, tiny fraction to pay for the management of the fund.
Correct. That is the accrued expenses. Plus, you might have payables money the fund owes for shares it bought but hasn't paid for yet.
So assets minus liabilities equals net assets. You divide that by the number of units, and you get the NAV. This brings us to what feels like the most important concept in this entire chapter, something called mark-to-market, or MTM.
NTM. It's the heartbeat of the entire system.
It sounds like trader jargon. We're marking it to market.
Yeah.
But the alternative, what they call historical cost accounting, it seems so much more intuitive. If I buy a house for 50 lakhs, I mentally think of it as a 50 lakh asset until the day I sell it. Why can't funds do that? Why do they have to update the price every single day?
This is a fantastic question, and the answer is pure game theory. Let's play out a scenario. Imagine a world without mark-to-market.
Okay, I'm listening.
You and I are both investors in a bond fund. The fund manager buys a bond for 100 rupees. In our imaginary historical cost world, the NAV reflects that bond at 100 rupees, day in, day out.
Simple, easy.
Now, let's say interest rates spike in the real world. When interest rates go up, bond prices go down. That is a fundamental rule of finance. So in the real market, that bond is now trading at 80 rupees. But because we are using historical cost, our fund's NAV still says it's worth 100.
Okay, so the NAV is lying. It says 100, but the actual asset is only worth 80.
It's lying, but it's consistently lying for everyone.
Yeah.
Now, here is where the theft happens. I'm a savvy investor. I watch the market. I know that bond is really worth 80, but I see the fund is still willing to buy back my units based on a value of 100.
So you sell, you get out.
I run to the exit. I redeem my units. The fund has to pay me 100 rupees per unit. I walk away with the full original value.
But wait, to pay you that 100 rupees, the fund manager has to actually sell the bond.
Exactly. And what can they sell the bond for in the real market?
Only 80 rupees.
Bingo.
Yeah.
So they sell the asset for 80, but they pay me 100. Where did that extra 20 rupees come from?
It came from the other investors.
From me. It came from you. It came from the people who stayed in the fund. By letting me exit at an artificially high price, the fund had to dip into the remaining assets to cover that difference. I effectively stole 20 rupees of value from every remaining investor.
Wow. That's a bank run waiting to happen. It's a race to the exit.
It is exactly a bank run dynamic. If you don't mark to market, the first person to panic gets 100 cents on the dollar, and the last person holding the bag gets, well, maybe 0.
So mark to market isn't just about showing volatility or making the charts look bouncy. It's about preventing theft. It ensures that if I want to leave, I leave at the current realizable value, so my exit doesn't hurt the people who choose to stay.
Realizable value. That is the golden phrase from Section 7.1. The valuation must reflect what we would actually get if we sold it today, not what we paid for it, not what we hope it's worth, what it is worth right now in the market.
That makes perfect sense. It's the great equalizer. Now, speaking of calculation, I noticed a tiny detail in Section 7.5 about decimal points. It seems really trivial, but the workbook makes a big deal about it.
Nothing in accounting is ever trivial.
It says NAV is calculated up to 4 decimal places for index, liquid, and debt funds, but only 2 decimal places for equity funds. Why? Why on earth does a liquid fund need 4 decimals? That's like a fraction of a page.
Think about the typical investor in a liquid fund. These aren't just retail folks like you and me putting in 5,000 rupees. These are often corporate treasuries parking 500 crores or 1,000 crores for just 3 days over a weekend.
Right. Massive volumes.
In a liquid fund, the daily return might be very, very small, maybe 0.01% or 0.02% for a single day. If you rounded the NAV to just 2 decimal places, that entire day's return might disappear in the rounding error.
Oh.
Or worse, the rounding error itself might be larger than the actual return.
I see. So if I'm moving 1,000 crores, a rounding error at the 3rd or 4th decimal place could mean a difference of lakhs of rupees.
Exactly. In high-volume, low-volatility funds, that precision is money. In an equity fund, the price is moving by 1% or 2% a day. A rounding difference of 0.001% is completely irrelevant noise. So 2 decimal places is perfectly fine.
Okay, we've covered the science part, the math of traded assets where you can just look up a price. But now we need to talk about the art, because not everything trades every single day.
The problem of illiquidity.
Section 7.1 outlines these fair valuation principles. It poses the scenario. What if the fund holds a corporate bond that hasn't traded in 3 weeks? You can't just look up the price on the NSE. The screen is blank.
This is where it gets really interesting. If you look up a stock price for Infosys, it's a fact. If you have to value a non-traded bond, it's an opinion.
An opinion? That sounds dangerous.
It is, which is why it's so heavily regulated. The overarching principle is good faith. The AMC, the asset management company, must value the asset in a true and fair manner.
But how? Do they just guess? Do they throw a dart at a board?
No. They use models. For debt securities, they often use something called matrix pricing.
Matrix pricing? Sounds like a sci-fi movie. Break it down for me.
They essentially construct the price synthetically. They start with a risk-free benchmark, that's usually a government security, a GSEC, with the same maturity. We know exactly what GSECs are worth because they trade constantly.
Okay, so that's the base layer, the foundation.
Then they add a credit spread. They look at the company's credit rating. Is it AAA or AA? They look at the sector it's in. They look at the current market conditions for corporate debt. Based on all that, they calculate a premium that investors would demand for holding that extra risk compared to the government.
So price equals the risk-free rate plus some kind of risk premium.
Roughly, yes. But it is a model. It's an estimate. And because it's an estimate, the regulations are very, very strict about consistency. You can't use Model A on Monday because it gives you a high price, and then switch to Model B on Tuesday because it suits you better. You have to pick a methodology and you have to stick to it.
And who's responsible if the model is wrong? The workbook says AMCs can hire third-party agencies to do this valuation for them.
They do. In India, we have major agencies like CRISIL and IGRA that provide valuation matrices to the industry. But Section 7.1 makes one thing crystal clear. The responsibility ultimately lies with the AMC.
So the buck stops with the fund house.
It has to. If the NAV is wrong, the AMC is liable. They cannot turn around and say, oh, the agency gave us the wrong number. They are the fiduciaries. They are the guardians of the investor's trust.
What defines non-traded, by the way? Is it just 1 day of no trading?
No, that would be chaos. The rule of thumb is 30 days. If a security hasn't traded on any stock exchange for 30 consecutive days, it is officially classified as non-traded or thinly traded. Before you hit that 30-day mark, you can generally look back at the last traded price. But once you cross that 30-day threshold, you have to enter this world of fair valuation.
Let's do a quick tangent on commodities.
Yeah.
Gold ETFs, for example. I'm assuming we don't use matrix pricing for gold bars.
Gold is simpler because it's a global asset, but it has its own specific rules. We don't just, ask the local jeweler in Mumbai what the rate is. The regulations specify using the AM fixing price of the LBMA.
The London Bullion Market Association.
Yes, it's the global benchmark. Every morning in London, a group of major banks agree on a clearing price for gold. We take that price, we convert it to US dollars, then we convert it to Indian rupees using the RBI reference rate, and then we add any applicable duties and levies.
It's fascinating how international this all gets. Your local gold ETF that you buy in India is actually priced based on a meeting that happens in London.
It removes any ambiguity. You don't want local demand spikes in Zaveri Bazaar skewing the valuation of a financial product that is meant to track global gold prices.
Okay, so we have the value. Now we need to talk about the cost, because this whole engine, it doesn't run on air.
Segment 3, the price tag. The total expense ratio, or TER.
I feel like TR is the one number everyone looks at, but almost nobody understands what's actually inside. I think most people just assume it's the fund manager's salary. I'm paying 2% so this guy can buy a nice car.
Well, the investment and advisory fee, which covers the manager's salary and all the research costs, is a big part of it, but it's far from the only thing. Section 7.2.4 lists a whole laundry list of expenses that can be charged to the scheme.
Let's run through a few of them.
Okay, there are registrar fees. That's the cost of maintaining the database of millions of investors. Who owns what, their bank details, their KYCs. There are custodian fees. That's the bank that actually holds the securities for safety.
Marketing and selling expenses.
This is often the most controversial one. This includes the commissions paid to distributors and agents who sell the fund.
Wait, hold on a second. Why am I paying for their marketing? If a shoe company wants to sell me shoes, they pay for the ads out of their own pocket. They don't add a marketing surcharge to my bill when I check out.
Well, technically they do. It's just built into the price of the shoe. In a mutual fund, it's a bit more explicit, but you are right to be skeptical. This is exactly why direct plans exist. In a direct plan, you bypass the distributor, you don't pay their commissions, so the TR is lower. But in a regular plan, that cost is bundled in.
Is there anything they can't charge to the fund?
Yes, and this is very important. Penalties. If the AMC violates a SEBI rule and gets fined 1 crore rupees, they cannot take that 1 crore from the scheme's assets.
Thank goodness, so I shouldn't have to pay for my fund manager's speeding ticket.
Exactly. That fine has to come out of the AMC's own profits, not out of the investors' pockets.
Now, talk to me about the slab system. I see this table in the workbook where the percentage they can charge keeps dropping as the assets go up. What's that about?
This is SEBI forcing economies of scale onto the industry. Think about it. Does it really cost 10 times as much effort to manage 1,000 crores as it does to manage 100 crores?
Probably not.
Yeah.
You still need the same research team, the same software, you just buy more shares.
Exactly. The fixed costs, the research, the software, the compliance team, they don't scale linearly. So SEBI imposed a tiered structure. For an equity fund on the first 500 crores of assets, you can charge up to 2.25%. On the next 250 crores, it drops to 2.00%. On the next 12,250 crores, it drops again to 1.75%, and so on.
It works just like income tax slabs.
It's the exact same logic. By the time you get to the balance of assets for really huge funds over 50,000 crores, the cap on that extra money drops to just 1.05%.
So mathematically, a massive fund, a blue whale fund, is structurally cheaper for you, the investor, than a tiny minnow fund.
Yes, the weighted average expense ratio of a giant fund will almost always be lower. It's a structural advantage that's built into the regulations.
That is a huge strategic insight right there. If I'm choosing between two very similar funds, the bigger one has a built-in head start on costs.
Correct. Although some would argue the bigger fund is harder to maneuver, it's less nimble, but purely on cost. Bigger is cheaper.
There is one weird exception in the cost structure, though, that I wanted to ask about. B30 cities.
Ah, the Beyond Top 30 incentive.
What is this? Is it a surcharge for living in a small town?
No, it's actually the opposite. It's an incentive for the AMC to go to the small towns. See, selling mutual funds in Mumbai or Delhi is relatively easy. The financial literacy is higher, the wealth is concentrated there. But selling in Tier 2 or Tier 3 cities, places like Ranchi, Mysore, Guwahati, that is hard work.
It takes more boots on the ground, more effort.
Exactly. So SEBI allows funds to charge additional expenses over and above the normal limits based on the new inflows they get from these B30 cities.
So they can charge everyone in the fund a little more to subsidize the cost of expanding the market into smaller towns.
In a way, yes. But the rule is very strict. That extra money must be used for distribution and marketing expenses in those specific regions. They can't just pocket it as extra profit.
So it's a policy tool designed to deepen financial inclusion across the country.
Precisely.
One last detail on costs GST. The taxman is always there, isn't he?
Always. But there is a very important nuance here that even professionals sometimes miss. GST applies to the services provided to the fund, but how it is charged depends on the service.
Okay.
GST on the management fee, that's the AMC's core earning, is charged over and above the TER limit.
So if the limit is 2.25%, the GST is added on top of that.
Yes. So the actual hit to your NAV is 2.25% plus GST. However, GST on other services like the custodian fee or the registrar fee has to be absorbed within the TER limit.
Oh, that is a squeeze on the AMC.
It is. It forces the AMC to be really efficient with their vendors because they can't just pass that tax cost onto the investor separately. It has to fit inside the overall cap.
Okay, moving on to segment 4. Pricing mechanics. We know the value, which is the NAV. We know the cost, the TER. Now let's look at the actual transaction.
Buying and selling, the world of loads.
I have to ask about entry load. I remember years ago, my uncle complaining that he invested 100 rupees and only 97 rupees showed up in his account statement.
That was the era of the entry load. For a long, long time, AMCs charged a fee, often 2.25%, right up front just to let you in the door, and that money went directly to the agent as a commission.
That sounds incredibly conducive to mis-selling.
It was wildly conducive to mis-selling. Agents would just churn portfolios. They'd make you sell Fund A and buy Fund B just to generate a new entry load commission for themselves.
So SEBI banned it?
SEBI dropped the hammer. Entry load is completely banned. Zero. Today, the sale price, the price you pay to buy a unit, is exactly equal to the applicable NAV. If the NAV is 24 rupees, you pay 24 rupees. 100% of your capital goes to work for you from day one.
That was a pivotal moment for the Indian mutual fund industry.
A huge one. It shifted the industry from a pure sales model to more of a service model, or at least that was the intention behind the move.
But while entry load is dead, exit load is very much alive and kicking.
Yes. But exit load serves a completely different purpose. Entry load was about paying commissions. Exit load is for, let's call it, behavior modification.
It's a penalty for quitting early.
It's a friction cost. It's there to discourage short-term flipping. You have to remember, mutual funds are designed for long-term investing. If you have people jumping in and out every week, you're a nuisance to the fund. You force the fund manager to hold too much cash. You increase transaction costs for everyone.
So the exit load acts as a deterrent.
Yes. The formula is simple. Your repurchase price equals the NAV multiplied by 1 minus the exit load percentage. If the NAV is 100 and the exit load is 1%, you get back 99.
Now, here is where I need you to be honest with me. Where does that 1 rupee go? Because I'm cynical. I just assume the AMC pockets it as a little goodbye fee.
I love the cynicism, but in this case, you were completely wrong. And this is, to me, the most beautiful part of the entire structure. The exit load net of any GST is credited back to the scheme.
Wait, really? It goes back into the pot?
It goes right back into the pot. The AMC is not allowed to touch a single paise of it.
So, if I am a long-term investor and I stay in the fund while other people are panicking and leaving early and paying that 1% fee, their exit penalties are actually adding to the NAV of my units. I'm getting their money.
Yes. You are effectively profiting from their impatience.
I love that. That's incredible. It's like a loyalty bonus that's funded entirely by the disloyal.
That is a perfect way to put it. It compensates the remaining investors for the liquidity costs and the transaction costs created by the exiting investors. It aligns the incentives perfectly with long-term wealth creation.
Okay, that completely changes my view on exit loads. I used to hate them. Now I kind of want other people to pay them.
Just don't pay them yourself.
Right. Now let's talk about another money flow dividends, or as we must now call them, IDCW.
Income distribution cum capital withdrawal. It just rolls off the tongue, doesn't it?
A branding disaster. Why did SEBI force such a clunky, horrible acronym on us?
Because the word dividend was a lie, or at least it was a dangerous misunderstanding for investors.
Oh, so?
In the world of stocks, a dividend is a reward. You own a share of Coca-Cola. Coca-Cola makes a profit. They send you a check. You still own the share of Coca-Cola, and the share price is still determined by the market.
Right. It feels like extra money on top of your investment.
In a mutual fund, a dividend is mathematically equivalent to you selling some of your units. It is not extra money. It is your money being handed back to you.
Walk us through the mechanics in Section 7.3.
Okay, suppose you own 1,000 units of a fund, and the NAV is 20 rupees. Your total investment value is 20,000 rupees. The fund then declares a dividend of 2 rupees per unit.
Okay, so I get a check in the mail or a bank transfer for 2,000 rupees.
You get a check for 2,000, but the moment that dividend is paid, the NAV of the fund drops by exactly 2 rupees. The NAV goes from 20 down to 18.
So now I have 1,000 units, but they're only worth 18 rupees each. That's 18,000 plus the 2,000 cash I just received. My total value is still 20,000.
Exactly. You are not one pays richer. You've just moved money from your left pocket, the investment, to your right pocket, your bank account.
And I usually had to pay tax on that transfer, didn't I?
Yes. In the old days, there was a dividend distribution tax. Now it's taxed at your marginal income tax rate. So essentially, the dividend option, the IDCW option, is just a forced withdrawal plan where the fund manager decides when you sell and you get to pay the tax bill.
That sounds terrible compared to a growth plan where I'm the one who controls when I sell and trigger a tax event.
For most people focused on wealth creation, the growth plan is mathematically superior because of the power of tax deferral. IDCW is really only suitable for people who need a regular cash flow and don't want the hassle of manually redeeming units themselves.
And there's a restriction on what they can pay out, right? They can't just pay out paper profits.
Correct. This is crucial. Section 7.3 states that dividends can only be paid from realized gains.
So if the portfolio goes up 50% in value, but the manager hasn't actually sold any of the winning stocks,
they cannot pay a dividend. They have to actually sell the assets, booking the profit, to create what's called a distributable reserve. They can't distribute unrealized valuation gains. This prevents the fund from paying out cash it doesn't actually have.
Okay, we're in the home stretch now, segment 6. We've talked about how the machine runs when the weather is good and everything is normal. Now we need to talk about the safety features for when the engine catches fire.
Crisis management.
Specifically, segregated portfolios and the strange case of perpetual bonds. Let's start with segregated portfolios, or what the industry usually calls side pocketing.
This mechanism was born out of pain. It was created to solve a very specific and very dangerous disaster scenario in debt funds.
Paint the picture for us. What's a disaster?
Okay, imagine a debt fund. It holds bonds from 50 different companies. It's considered safe, stable. But suddenly, one of those companies, let's call it Badco, defaults. They miss an interest payment. The rating agencies immediately slash their credit rating to D for default.
And the value of that Badco bond just crashes instantly.
It drops maybe 50% or even 100% in a single day. The NAV of the entire fund takes a big sudden hit. Now investors panic. They see the NAV drop and they think, I need to get my money out before it drops even more.
It's the run on the bank all over again.
Yes. But here is the critical problem. The fund manager needs cash to pay the people who are leaving. But nobody in the market wants to buy the Badco bonds. They're toxic. So to raise cash, the manager is forced to sell the good bonds, the Tata bonds, the HDFC bonds.
So it's a death spiral. You are selling the good silver to pay for the garbage you can't get rid of.
Exactly. The people who get out early get paid. The people who stay behind are left with a portfolio that is shrinking, but the percentage of Badco garbage in it is actually rising every day. The loyal investors are left holding all the toxic waste.
That is fundamentally unfair. So how does a side pocket fix this disaster?
The moment the credit event happens, the AMC has the option to split the fund into two separate funds. Fund A, the main portfolio, keeps all the good, healthy, liquid assets. Fund B, the segregated portfolio, takes the Badco bonds and only the Badco bonds.
They quarantine the virus?
Yes, that's a perfect analogy. All existing investors get units in both funds. You get your main units and you get these new segregated units.
But I can't sell the segregated units, right? They're basically worthless for now.
No, they are locked. They are frozen. You can redeem your main units anytime you want at the fair value of all the good assets, but you are stuck with the segregated units until the AMC manages to recover some money from Badco through a legal process or a restructuring.
So this stops the panic, because if I run for the exit, I don't escape the bad debt. My share of it follows me into this side pocket.
Exactly. There is no advantage to leaving early anymore. It stabilizes the entire fund and treats all investors fairly.
And what about fees? Please tell me they don't charge me a management fee for holding my money in a frozen defaulted bond.
They cannot. The rules are very clear. The AMC cannot charge investment and advisory fees on the segregated portfolio. Unless they actually recover the money. If they fight the legal battle for 2 years and get Badco to pay back 40% of the value, then they can charge fees on that recovered amount.
I like that. You only eat what you kill.
Yeah.
It perfectly aligns their incentive to chase down that recovery for the investors.
It's a very robust and fair system, born from some hard lessons.
Finally, let's just touch on the most complex instrument mentioned in the chapter, perpetual bonds, or AT1 bonds.
Additional Tier 1 bonds. These are typically issued by banks. They offer a very high interest rate, but they have a massive catch. They technically never mature.
Never.
Never. The bank usually has a call option to buy them back, maybe every 5 or 10 years, but they aren't obligated to do so.
So how on earth do you value a bond that might last until the heat death of the universe?
That is the billion-dollar question. For a long time, mutual funds valued them by assuming the bank would buy them back at the first opportunity, so they treated them like simple 5-year bonds.
Which makes them look very safe and stable on paper.
Right. But then we had the Yes Bank crisis, where these bonds were completely written down to zero. And SEBI realized that treating these as short-term instruments was incredibly risky. So they introduced the 100-year rule.
What is that?
SEBI mandated that for valuation purposes, mutual funds must assume these bonds have a maturity of 100 years from the date of issuance.
100 years? That seemed so arbitrary.
It sounds arbitrary, but it's actually very clever mathematics. In bond math, the longer the maturity, the more sensitive the price is to any change in interest rates. A 100-year bond is incredibly volatile. If interest rates tick up just slightly, the price of a 100-year bond crashes.
So by forcing them to use 100 years, SEBI effectively forced the daily NAV to reflect the extreme volatility and risk that is inherent in these instruments.
Exactly. It forced the riskometer on the fund to show the truth. And they also capped the exposure. No single fund can hold more than 10% of these instruments from a single issuer.
Diversification by decree.
It prevents a single bank failure from wiping out an entire mutual fund.
We have covered a massive amount of ground today. I mean, from the daily grind of the NAV calculation to the nuances of accrued income, the structural advantage of the slab system, the unexpected fairness of exit loads, and the quarantine logic of side pockets.
It is a heavy chapter, but I think it's probably the most important one in the entire book.
If I had to synthesize all of this for the listener, I'd say the NAV is the scorecard. Fair valuation is the referee who makes sure the score isn't rigged. TER is the admission fee to play the game. And IDCW and loads are the house rules for entering and leaving the casino.
That is a brilliant summary. And if I may add just one final philosophical layer to that.
Please.
All of these rules we've discussed, mark-to-market, fair valuation matrices, segregated portfolios, they are all designed to answer one fundamental question. What is this asset worth if we had to sell it right now?
Realizable value. Back to that phrase.
Yes. But imagine a scenario, a true global market crash, a 2008 level event where liquidity completely dries up, where nothing is trading, the bond market freezes solid, the stock market is just hitting lower circuits day after day.
The doomsday scenario.
In that moment, the models stop working. The good faith estimates become just guesses. And it makes you realize that liquidity, the simple ability to actually find a buyer for your asset, is the ultimate invisible asset in any portfolio.
That is a chilling thought. A price on a screen is only real if there is someone on the other side who is willing and able to pay it.
Precisely. The NAV is a promise of value, but liquidity is the delivery of that value.
Well, on that slightly terrifying but deeply insightful note, we are going to wrap up this deep dive into NISM Chapter 7.
It's been a real pleasure.
Next time you log into your portfolio app and you see that NAV number, remember the massive machinery of math, regulation, and ethics that worked all day to put it there. Check your expense ratio. Appreciate your exit load, assuming, of course, you're staying put. And thanks for listening to The Deep Dive.
Stick your